This is Nightly Business Report with Tyler Matheson and Sue Herrera.
A bottom or a bounce? Stocks skydive only to trim their losses. Is there a sense now on Wall Street that the worst of this selling spree is over?
Threat to sales, autos and housing are coming off strong years. But will Americans keep buying if their portfolios are shriveling?
And tough choices. If you are close to retirement, what decisions do you need to make now with the markets flying? All that and more tonight on Nightly Business Report for Wednesday, January 20th.
Good evening, everyone, and welcome. A wild Wednesday on Wall Street ends with the Dow only losing 249 points. Only. It was that kind of a day. Stocks started lower, then plummeted hard midday, falling more than 560 points. And just when it looked really scary, the indexes started rising, cutting their losses almost in half. The Dow traveling about 1,100 points total for the day. And by the close, the Dow Jones Industrial Average lost 249 points to 15,766. The Nasdaq fell 5 points. The S&P 500 lost 22. As for crude, which of course is at the center of the sell-off, prices settled down nearly 7% to the lowest level since May of 2003. Bob Pisani tells us whether today's market move is a sign the worst of the selling is over.
Is this capitulation? Well, do you believe we're in a bear market or not? One thing's for sure. For a brief moment in the middle of the day, we saw some very strange numbers. I mean, really strange. Almost 40% of the stocks at the New York Stock Exchange were at 52-week lows. There were 30 stocks down for every one that was up. That is a weird number. And volume was twice as heavy as usual. Now, all this suggests panic, and it's usually associated with at least a short-term market bottom. And that's exactly what happened. Stocks rallied in the middle of the day, and they rallied hard. The Dow Transports rallied almost 300 points from the top to the bottom. That's about 5%. And traders cheered when the index went positive. Now, here's the problem. This only suggests that the selling has halted for the moment. In bear markets, you always get rallies. Some of them last for a day, some of them last for a few days. But then the markets just droop again. So you have to believe one of two things. First, if you believe this is just a garden variety sell-off, and so far the S&P is only down 13% from its highs last year, that's a garden variety sell-off, then there's a good chance we're near the bottom. But if you think we are headed for a steeper drop, and many feel we could drop another 10% or more, then today's action and the likely modest bounce we will get tomorrow is just a brief respite. So ladies and gentlemen, place your bets. For Nightly Business Report, I'm Bob Pisani at the New York Stock Exchange.
Meantime, a dark cloud of investor anxiety hangs over the World Economic Forum in Davos, Switzerland. That's the annual meeting of business and political leaders, and it comes at a time this year when trillions of dollars have been wiped from stock market values worldwide. Andrew Ross Sorkin is there, and he spoke with some very powerful names in investing about the state of the global economy.
We're here in Davos, Switzerland, at the World Economic Forum, where we had a chance to catch up with some of the biggest leaders in the world of finance amid all of these market gyrations, trying to understand what's happening in the real economy, where it is today and where it's all headed.
I think the risks are asymmetric on the downside. That's why I said before that I think the next major move in Fed policy will be toward a quantitative easing, not toward a tightening.
The consumer's confident, unemployment's down, the wages are growing, not as fast as people would like, but they're growing, and so we see that, and that's kind of the tug of war. That versus these other external impacts is going to be interesting as we play out the first quarter, I think.
We had 200 and plus thousand jobs created every month over the last year. American companies, while experiencing some issues on the edges, still continue on that pace of job growth.
China is actually slowing, but it's not collapsing. And I think there's like an overreaction to what's going on there.
We have to put China in context of what they did in the last 20 years and what they can do in the next 10, 15 years. That's the reason why we are bullish on China.
We're now in a situation globally where China plays an important role on the rest of the world, and the rest of the world plays a role on China, and that is negative.
We're having slow growth. I wish it was more. China, I think they have the wherewithal to grow at their 5 or 6%. Europe is going to grow a little bit. So, yeah, it's going to be worse than we thought, but it's possible. I'm hopeful that this is all a big adjustment, and, in a couple of weeks we'll take a deep breath and say, thank God that's over.
For Nightly Business Report in Davos, Switzerland, I'm Andrew Ross Sorkin.
Here in the U.S., consumer prices fell in December and posted the smallest annual increase in 7 years. Part of the reason is that big drop in energy prices. The Consumer Price Index declined 0.1% last month. According to the Labor Department, core inflation, which excludes energy costs and food costs, rose 0.1%, the smallest monthly gain since August.
Home building fell unexpectedly in December with declines in both single and multifamily construction. Housing starts dropped 2.5% from the prior month. The Commerce Department also said permits, a sign of future building activity, were weak, suggesting the housing market lost momentum at the end of last year.
That weak data is diminishing expectations that the Federal Reserve will raise interest rates when it meets in March. In fact, some are saying the central bank may only raise rates once this year, one and done, compared to just a few weeks ago when 4 rate hikes were expected. And many will be paying very close attention to the Fed's next meeting, which is next week, and comments from Chair Janet Yellen to potentially calm the markets. Danielle DiMartino Booth is head of economic consulting firm Money Strong and a former advisor to the Dallas Federal Reserve. Welcome. Nice to have you here.
Thanks for having me, Sue.
So at this point, given what you've seen in the markets and also some weak economic data, lack of inflation, where does this put the Fed?
Well, it's interesting. Standard & Poor's Howard Silverblatt put out some interesting statistics at the end of the trading day that showed that outside of the ructions that we saw around 2009, that we're living through a period of unprecedented volatility in the stock market. So it's not just the up days, the down days. It's the level of volatility that I think is really going to capture policymakers' attention in the same fashion it did at the end of August.
You know, Danielle, you've worked with and advised the Dallas Fed, and so you know the kinds of conversations that take place within the Federal Reserve. Take me inside there. How much do the Fed governors, do the Fed bank presidents, how much do they take into account as they get ready to go and talk about interest rates? What's going on in the broader world of the markets?
Well, you know, I think that this is kind of an era of learning inside the Federal Reserve, if you will, because it used to be that the rest of the world followed the United States. And what we've discovered since China preemptively devalued the yuan back in August is that other areas of the global economy now have a pull on our own economy, and we're really not used to seeing that. And I can tell you, policymakers, for them at least, this is a new era of making policy, and you know, it's at their peril, I think, that they discard what's going on in other areas of the world.
So if you were a betting person, do they raise rates in March, all things being equal, and the market's volatility, which is expected to continue?
You know, I listened to the technical analysts and what Bob Pisani was just saying right now, and we certainly could see a roaring comeback in the markets in the weeks that come. But judging from what my good friend Art Cashin had to say about the quality of jobs produced in the month of December, I venture to say that policymakers are going to be paying very close attention to whether or not the market rebounds and the economic data come in better than expected in the months to come, and the international situation calms down. So there are a lot of factors going into whether or not they'll pull the trigger in March. And I would say right now the chances are very much against that happening.
Danielle, nice to have you on the program. Thanks for joining us.
Thank you for having me.
Danielle DiMartino Booth.
All right, growing fears the economy is slowing has many reevaluating now the outlook for almost every sector, including those that have been doing pretty well. 2 prime examples, autos and housing, despite today's weak numbers on housing. But after a record year for vehicle sales and rising home prices, is the market sell-off a threat to these 2 industries? Diana Olick takes a look at housing, but first, Phil LeBeau on autos.
It's the tale of 2 worlds. Stock markets around the globe are hitting the brakes, but in the auto industry, business is still accelerating. In fact, global sales this year are expected to hit another all-time high, thanks to increases in China, Europe, and the U.S. Today, President Obama celebrated the resurgence of America's auto industry while touring the Detroit Auto Show.
Today, factories are humming, business is booming, the American auto industry is all the way back.
So far, buyers have shrugged off talk of the economy slowing down. Auto sales historically move in tandem with consumer confidence, which remains high. Housing starts are increasing, which is expected to help demand for pickups. And auto loan interest rates remain relatively low. All of this convinces leaders in the auto industry that business should stay strong, even as they see weakness in stock markets around the world. Phil LeBeau, Nightly Business Report, Chicago.
Call it the upside to the sharp downturn in stocks. Mortgage rates are heading back toward record lows again, and that just means more buying power for house hunters pounding the pavement today. The average rate on the popular 30-year fixed is down below 4%, the lowest of this year and much of last year. But there are bigger factors at play in housing today, namely supply or lack of it. Home sales have been weakening because there are so few listings, and what is out there is either overpriced or has been sitting on the market for a reason. Today's read on December housing starts, down over 3% from November, was particularly disappointing, given December was one of the warmest on record. Sure, consumer confidence is a factor. A home is the biggest purchase most consumers will ever make, and if they get nervous about the economy and their jobs, they might pull back.
There's areas of the U.S. economy, such as the U.S. consumer, that are in the best shape that they've been in 10 years. The US housing market, which has not only all the benefits of strong real income growth at the consumer level, but you've also got mortgage rates, 30-year mortgage rates at 3.74 still, and you've got huge demographic tailwinds behind you as well. So there's a few areas there in the US economy that just aren't impacted at all by emerging markets, and that's where we actually see the opportunities right now.
But really, today's housing market is fueled by huge pent-up demand, job growth, and demographics that all favor increased sales. That is, as long as there's something to buy. There is one caveat, and that is for those relying on stock portfolios to buy the home. This is not a huge share of buyers, but for those heavy into equities, their net worth has fallen quite a bit over the last few weeks, and that could hurt when it comes to qualifying for a loan or using stocks to fund a down payment. For Nightly Business Report, I'm Diana Olick in Washington.
Still ahead, a major oil company feels some major profit pain from the plunging price of oil.
Royal Dutch Shell is the latest victim of the rout in oil prices. The energy company warning investors that profits likely plunged 50% last quarter compared with a year earlier. And as Morgan Brennan reports, Shell is hardly suffering alone.
Royal Dutch Shell issuing disappointing earnings guidance ahead of a much-anticipated shareholder vote on the proposed $50 billion acquisition of rival BG Group. As part of the announcement, it also said spending for the merged companies would be slashed by a staggering 45%, and that layoffs would total 10,000 workers. The warning comes as crude prices tumble to 12-year lows, stoking fears that current levels are unsustainable for many companies and oil-producing countries and could potentially result in a global contagion. Shell sheds light on what's anticipated to be another tough quarter. Energy sector earnings are estimated to have fallen more than 70% in the last 3 months of 2015. But as the integrated oil companies, including Chevron and ExxonMobil, prepare to report in coming weeks, analysts are less focused on last quarter and more concerned about forecasts for 2016. Alan Good, senior equity analyst from Morningstar, expects to see sharply lower profitability in production again, with refining operations remaining fairly robust. He and others say this earnings season, the biggest topics will be spending budgets, plans for future projects, and perhaps most importantly for investors, promises that dividends will continue to remain intact, at least for now. For Nightly Business Report, I'm Morgan Brennan.
And it's not just energy companies that are feeling the effects of low oil prices. The big banks are as well. As we've been telling you, Wall Street firms issued loans to help finance all those drilling projects. And now we know which financial institutions have the biggest exposure. Kayla Tausche has more.
The S&P financial sector has fared nearly as badly this year as the energy sector because it's almost as directly affected by the price of oil. And that correlation plays out in two specific ways. First, as stress in the oil market continues hurting global growth, the Federal Reserve is faced with a tougher case to raise rates this year, and that was supposed to be the big benefit to bank stocks. Then banks chased the energy boom for the last several years, loading debt onto companies trying to drill for oil and gas. Lower prices mean less profits for those companies, and they're less able to pay their debts. And those debts are what investors are most interested in and why executives have gone to great lengths to lay out exactly by how much they're at risk. Goldman Sachs on today's earnings call said it has $10.5 billion in direct exposure. Bank of America and Citigroup have north of $20 billion, Wells Fargo $17 billion, JP Morgan $14 billion. Morgan Stanley's is $5 billion, but for that bank, it's the biggest share of its overall lending. More important, though, is how much the banks are setting aside should a portion of those portfolios go belly up. According to an analyst at Goldman Sachs, Wells Fargo is setting aside the most, Bank of America the least. And even though all of these banks have different size portfolios, different types of risk, they all say if oil continues to stay low, their costs will only go one direction, and that is up. For Nightly Business Report, I'm Kayla Tausche in New York.
Oil is also playing a part in presidential politics these days. The governor of Iowa said he wants Republican candidate Ted Cruz defeated. He said Cruz is in the pockets of big oil and called him the biggest opponent of renewable fuels. The comments come just weeks before voters turn out to caucus in the ethanol-rich state of Iowa. John Harwood is following the story for us. John, how unusual is it for a governor not to endorse a candidate, but to say, don't vote for one?
It's very unusual, Tyler. Terry Branstad's the longest-serving governor in American history, and it's extraordinary for him to single out Ted Cruz. This is in part because of the issue of ethanol, renewable fuel, popular among Iowa corn growers, but it's also because a lot of Republican elected officials really don't like Ted Cruz.
What does it tell us, though, about this presidential campaign, which has been different from almost any other we've seen in recent memory?
Well, the role, Sue, of ideology in this Republican race is much different than it's been in the past. The drift of the Republican Party has been to get more and more conservative, and you even, in fact, had an Iowa senator elected 2 years ago who was a little bit squishy on those ethanol mandates that was unconventional, and that's because she criticized it, like other Republicans, as crony capitalism. But in this particular race, Donald Trump is scrambling all of those categories, and he's been endorsed by Sarah Palin the last couple of days, and she was out saying, hey, what is the GOP establishment calling us not ideologically pure enough, given all the things that they've done and not done for the American people?
John Harwood, thanks very much. John in Washington tonight.
A massive fine drags down profits at Goldman Sachs, and that's where we begin tonight's Market Focus. The Dow component saw its quarterly earnings fall more than 60%, but it was still enough to beat estimates on an adjusted basis. The drop was from a recently announced $5 billion settlement over mortgage bond sales leading up to the financial crisis. If you take out that fine, the investment bank's earnings would have risen. Shares of Goldman were off about 3% today to $153.75. Staples and Office Depot are extending their merger deadline for 3 months. This will allow the office supply chains to complete their deal, which has come under fire from antitrust regulators. Staples agreed to buy its rival last February for a little bit more than $6 billion. Shares of Staples were up fractionally. Office Depot shares were lower.
TD Ameritrade beat earnings estimates and matched revenue targets in its latest quarter. The company did say that it is well positioned to benefit from a rising interest rate environment. TD Ameritrade shares, though, fell 2% today to $28.31. Brinker International, which owns the Chili's restaurant chain, said revenue fell because of traffic declines in its stores. Earnings, however, rose thanks to the acquisition of more than 100 franchisee-owned stores. Shares of Brinker, which trade under the wonderful symbol EAT, off 3% to $46.63.
Well, despite some concerns over economic growth, one area that's expected to do well is franchising, and it's being helped in part by lower oil prices. Kate Rogers takes a look at just how fast this segment is expected to grow.
Robert Dorfman is a believer in the franchise model.
I think it gives small business people like myself a great opportunity to leverage some brand equity, which is very difficult to create over a short period of time, and to use that brand identity to then take the kind of entrepreneurial spirit and control my own destiny.
He's gearing up to open his second World of Beer location in Loudoun, Virginia this spring. Before that, he owned nearly 36 Five Guys Burgers and Fries locations in 7 states. Past success has Dorfman betting on a strong 2016. And he's not alone. The International Franchise Association is forecasting a 6th straight year of solid growth for the industry. Nationwide, the total number of franchise locations is estimated to grow to nearly 796,000, employing more than 9 million workers. Increased business spending and lower oil prices are expected to help the franchise industry's GDP grow to $552 billion. Despite his sunny outlook, Dorfman has concerns about how future regulations may impact his growth. Minimum wage and the Affordable Care Act are top of mind. In 2016, small businesses with as little as 50 or more full-time employees will have to offer those workers insurance or will face fines of up to $2,000 per worker per year for failing to comply.
I am a strong proponent of providing all of my employees, making sure they're well compensated, that they have appropriate benefits, that they feel great about the environment in which they work. However, the Affordable Care Act is going to put a serious financial limitation on myself as a small business person.
Also on the minds of franchisees, a pending case before the National Labor Relations Board against McDonald's on joint employer status. Industry advocates say if McDonald's loses and parent companies are held responsible for actions at their franchise locations, the industry's growth could come to a halt. For Nightly Business Report, I'm Kate Rogers.
To read more about potential growth in the franchise sector, head to our website, nbr.com.
Coming up, are you nearing retirement? As uncertainty grows in the markets, there are some steps you may want to take now to protect your nest egg.
A lot of people get caught up in the emotion of it, and that helps drive the stock market down. But overall, I think the economy is okay, and I think the underlying fundamentals are good.
Might change some investments that I have, maybe pull out of a couple of things just in case. I know everyone always says wait for the long term, but still a little bit scary to kind of think about that.
I think that's a lot of panic sellers, and I've always been a follower of just stick it out.
Well, some investors are nervous and others, as you saw there, are staying the course. And today, Jack Bogle, the founder of the Vanguard Group, the world's largest mutual fund company, said that's exactly what retirement savers should do.
This is really important. This is the most serious piece of advice I could give people. If you're investing in a retirement plan, as tens of millions of people are, don't stop investing when the market goes down. The prices are 10% better than they were. Keep investing. Keep putting money in, just as you would. Don't interrupt your savings pattern, because you'll pay a huge price for it in the long run.
But what if you are close to retirement? A year, 2 years, 3 years. This market may be too nerve-wracking to ride out the volatility. Joining us in our retirement red zone is financial advisor Rick Edelman. He's chairman and CEO of Edelman Financial Services. Rick, always great to see you. I count you as a friend and a guy I respect a great deal. Let's talk about if I'm close to retirement, and let's say I feel like I need to transition from 60% equities to something like 50% equities. Do I do that all at once, or do I do that gradually over a period of months?
Tyler, always great to be with you. No, don't do it at all. It's an emotional response, and as Jack Bogle just said, you don't want to do this when prices are low, because all you'll be doing is locking in that low level. So if you do feel motivated to go from 60% allocation to 50, you should have done that before. In other words, you didn't want to before because prices were good and we're feeling really great. So don't succumb to the emotional temptation, because that's what will do us in. So I would say stick it out, hang in there, stay with your allocation, wait for prices to recover.
Or maybe use the opportunity to revisit your plan and then work with your financial
advisors.
advisors.
Exactly right, Sue, and that's really the key point. Many people are shocked right now, not with the money that they lost, but how fast they lost it. 10% in a matter of weeks, that's very shocking and upsetting. And that could mean that your allocation isn't right in the first place. If that is true, or if you're even not sure, it's a wonderful opportunity to talk to a financial planner who can verify for you if you're properly positioned, and if not, now is indeed a good time to make needed changes.
As I get get within, what advice do you give to your clients and what do you do in their portfolios as they get to within 5 years of retirement? What kind of changes do you make either in the allocation between stocks and bonds or the kinds of funds that you would put them in on the equity or the bond side?
The key is the allocation, Tyler, very much. And that's the savings grace here. If you're within 5 years, not of retiring, that's a misnomer, 5 years of using the money. A lot of people retire, but they're going to leave the money intact because they're not going to need it for a while. But if you're within 5 years of actually spending the money, then we might want to reduce the equity allocation. In other words, don't have so much money in stocks if you're planning on using the money within 3, 4, 5 years. So we would want to keep that in check. And that's the good news for retirees. It's pretty rare to come upon a near retiree who has 100% of their money in the stock market. Odds are you're being more conservative, more cautious, more careful than that, and that's getting you through the day right now.
All right, Rick, thank you very much. Rick Edelman, Chairman and CEO of Edelman Financial Services. Well, before we go, here's a look at the market sell-off today. The Dow lost 249 points to 15,766. The Nasdaq fell 5. And the S&P 500 lost 22. But as we said to you a little bit earlier today, it was pretty darn ugly. We were down 566 points, I think, at the low point of trading today.
We began the broadcast tonight with Bob Pisani questioning whether this was the bottom,
right,
whether the turn happened sometime around 3 o'clock. Obviously, only time will tell. There were some signs. Volatility was way up. Volume was way up. Right. The decliners beating the advancers 11-1 or something like that at that point. And so it was a very volatile day. We'll look back on this one. A new president a year from today.
Oh, that's right. Absolutely.
Day.
All right, that does it from Nightly Business Report for tonight. I'm Sue Herrera. Thanks for joining us.
And I'm Tyler Mathisen. Have a great evening, everybody. We will see you back here tomorrow.